Welcome to our global market forecast, brought to you by Options 21, with a special emphasis on the Australian dollar. Let's start with having a look at the S&P 500, and what we'll notice in the past week is that the S&P 500 managed to break and close above its recent highs, that is back in October, which is a confirmation of the continuation of an upward trending market. The blue angled line at the bottom of the screen represents a trend line from 2009, which remains unbroken. So officially, as of the past week, we now have what's called a higher low. That's the bottom of the screen at the beginning of the year. And this particular upward moving bull market, in a technical sense, is confirmed to the upside. That does not mean strong growth into the near future. In fact, I would suggest there's a high probability of resistance in the not too distant future. I'm talking months out, but it does confirm our consensus that, technically speaking, what we were describing in the past weeks, that was a market that was putting in a technical accumulation phase by the production of what's called an inverted head and shoulders pattern, which is a strong and very large base, is now not only obviously confirmed, but was the launching pad for the continuation and the acceleration of US equity markets. In the future, when we get to points of potential resistance, we will examine those on screen, but we're not quite there yet. In the short term, I would suggest, due to interest rates discussions by the US Federal Reserve, we are at the point of a pullback. A pullback is not to be feared. A pullback is simply a slowing down of the rate of change of price in upward movement. So I would suggest to you, in the next week or so, we'll see, as we did back in early March, as we did back in late March, a market that corrects back to its short-term trend line, defined by a line below previous lows, and also defined by a 20-period exponential moving average, which is the thin blue line on screen. That point, or that pullback, is absolutely ideal if you believe the market is continuing to the upside and you have cash to put to the market at the end of that pullback. That is absolutely an ideal point in which to buy stocks. The question is which stocks, and that can be answered if you wish to contact me at any time. The which stocks question is answered by understanding which sector and industry to join into, and the which sector is the strongest sectors of US markets, and the strongest industries and the strongest stocks. I often refer to internal measurements of the S&P 500, and that is how many advancing stocks and how many declining stocks are in play. Most importantly, not only is the number important, but the volume of advancing versus the volume of declining. I'm just going to stick with the volume of advancing and the volume of declining, because back on April 11th, the volume of advancing stocks, in fact the number was 293 advancing stocks, 180 declining stocks. The advancing stocks in volume were 68% greater than the declining stock volume. Moving forward 1 week from April 11th, jumping to April 18th, the advancing stocks were 266, the declining stocks 208. So you can see there's a decline coming up. And most importantly, the volume of advancing stocks was 24% above the declining stocks. So it's 68 last week, 24 this week. Moving forward to the Thursday, the 25th of April, the numeric value of advancing was 256, declining was 218, but the volume of advancing was only 14%. Do you see what's happening here? 68% above, 24% above, 14% above, and this week it's absolutely gone in reverse. It's now negative 14%. So we've got advancing stocks are less than, the volume of advancing stocks are less than the volume of declining stocks. So having the view that are potential tops coming in, and these numbers support the contention that we're looking at the point of a potential pullback, not talking about a correction, just a pullback, which is actually an opportunity to be taken advantage of. Just quickly looking at the IWM, we covered this over many weeks. It's still displaying obviously an inverted head and shoulders pattern, which is a broad-based accumulation pattern, and it continues to put in a right shoulder. That is a sign of weakness because the broader market, that is S&P 500, the higher cap market has broken to the upside and has continued up, and the mid-cap market, which is represented by the Russell 2000, has tracked sideways. Sometimes the Russell is the canary in the coal mine. It can be a little bit more sensitive, and I won't say it preempts. The key, though, is that we follow S&P 500. This is an interesting addition to our analysis. Let's go country by country, looking at whether the synchronization of global equity markets is holding true. It's something that we presented to you 3 or 4 weeks ago, and that is a true statement because this is the DAX. The DAX has broken up out of its inverted head and shoulders pattern, broad-based patterns. Usually are the springboard for large expansions in indices, and this is a true statement because it's exactly what happens, and it has continuing to happen as of last week. This is a graphical representation of the Shanghai Composite Index. You can see once again between October and January we put in a broad-based accumulation pattern. This in the terminology is a double bottom, and it's had this very large rally and continues to rally. Of course we've seen a pullback, and that pullback would also have been in alignment with metals and mining indices. There's a very high correlation between the two, and it's still in an upward trend until otherwise proven. Just as an aside, the Chinese market currently is the strongest index market on the planet. Just moving across to the United Kingdom, the only chart I've got is an exchange traded fund chart, EWU, but it tells the story of accumulation and break. The only, I suppose, slight difference between United Kingdom and Germany is the strength of the movement is not as strong in its momentum, and this particular chart is starting to slightly roll over. It is slowing down, but Brexit is not holding global portfolio managers from rebalancing their portfolios with UK stocks. It is moving strongly to the upside. Let's shift across to the Canadian, last North American market. Very deep capitulation phase back in December, January. Well-formed accumulation pattern, broad-based, which is the beginning of a large extension. That extension is occurring as we speak, and markets are accelerating after we see this pullback in probably global markets driven by the US. My belief is everything will continue to the upside. Last of all, we've got the Australian market, ASX, S&P 200, and this has also put a large basing pattern at the beginning of the year and continues to do a series of higher highs and higher lows. Is a little bit overbought at the moment and is pulling back, and it'll probably do so in alignment with other global indices around the world. In summary of global indices, all global indices are synchronized to the upside and should continue to do so with the expectation, as already stated, of a pullback in the market, which is an opportunity to rebalance your portfolio. The last item in this presentation is the Australian dollar. I pick up a different item each week. Last week I did gold, this week I picked up a currency. The Australian dollar is, if I go to a weekly chart, has been in a strong decline from 2000, I just get the exact date, 22nd of the 1st, 2018, the Australian dollar's been in a strong decline against a very strong US dollar. This particular picture represents FXA, which is the exchange traded fund traded on, I believe, NYSE, and that, in a technical sense, if I come back to a daily chart, shows nothing but weakness. That is, from a close-in daily technical perspective, we have a series of lower lows and lower highs primarily residing underneath that long-term trend line. Just recently, in late April, it did stick its head above that long-term trend line, but it's now collapsed due to changes of interest rate expectations by the Reserve Bank of Australia, and looks pretty strong to the downside. In the context of institutional volume support for this particular contract, there is none. There's no buying activity. It is all selling activity, and that supports the contention that this particular contract will continue to the downside. If it is to continue to the downside, you'd expect a strong US dollar, and we can see that if we go across to a US Australian dollar pair chart traded on the Australian Securities Exchange. It is in a strong uptrend with no indication other than the market doing a series of higher highs and higher lows. From last week, the market has broken into a new high. Another insight when we're looking at currency markets could be to view the US dollar index. The US dollar index is an index, US dollar against a basket of currencies dominated by the euro, and as we can see, it's also in a very strong uptrend. So there's no indication of weakness in the US dollar, which supports the contention. Anything opposing US dollar is probably being pressured to the downside, which could include what I spoke to about last week. That was gold, which I'm not going to cover today. That's it. Thank you. Just one last thing before I go. If you ever want to contact me, you may do so. My email is paul@momentuminvesting.com.au. That's paul@momentuminvesting.com.au. Always happy to hear if you've got specific questions or you want to learn, a broader quantitative or technical analysis of financial markets. Please contact me. Thank you.